Interest rates. They sound complicated, but they're really not. Think of interest rates as the price of money. When you borrow money, the interest rate is what you pay to use that money. It's like a rental fee. When you save money, the interest rate is what the bank pays you for keeping your money there. It's like earning rent on your money. So interest rates are a two-way street, affecting both borrowers and savers. Now, who decides these interest rates? In most countries, it's the central bank. In the United States, it's the Federal Reserve, often called the Fed. Think of the central bank as the conductor of an orchestra. Their job is to keep the economy stable. They do this by raising or lowering interest rates. When the economy is sluggish, the Fed might lower rates to encourage borrowing and spending. When the economy is overheating, they might raise rates to cool things down. It's all about finding the right balance. Interest rates don't just change randomly, they are influenced by a variety of economic factors and decisions made by financial authorities. They move up or down based on what's happening in the economy, reflecting the broader economic conditions and trends. It's like a big puzzle with many pieces. One crucial piece is inflation. Inflation is when prices for goods and services go up, reducing the purchasing power of money. When inflation is high, the Federal Reserve might raise interest rates to try to slow down spending and bring prices down, aiming to stabilize the economy. Another important piece is economic growth. If the economy is growing too slowly, the Fed might lower interest rates to encourage businesses to borrow and invest, which can create jobs and boost growth, stimulating economic activity. It's a delicate balancing act, requiring careful consideration of multiple factors. The Fed looks at all these factors and more when deciding whether to adjust interest rates, aiming to maintain economic stability and growth. Section 4, Interest Rates and Loans, Your Mortgage and Car Payments. In this section, we will delve into how interest rates can significantly affect your financial commitments, particularly your mortgage and car payments. Interest rates have a big impact on loans, especially big ones like mortgages and car loans. These rates determine how much extra you will pay over the life of the loan. Imagine you're taking out a $300,000 mortgage. The interest rate you secure will dictate your monthly payment and the total amount you will end up paying. If interest rates are low, say 4%, your monthly payments will be lower than if rates were high, say 7%. This difference can amount to hundreds of dollars each month. Why? Because with a lower interest rate, you're paying less to borrow that money. Essentially, the cost of borrowing decreases, making it more affordable. That means more money in your pocket each month. You can use these savings for other expenses, investments, or even paying off your loan faster. The same principle applies to car loans, credit card debt, and any other type of loan. Lower interest rates reduce your financial burden, making it easier to manage your monthly budget. Lower rates mean lower payments, and higher rates mean higher payments. Understanding this can help you make better financial decisions and plan for a more secure future. Section 5. Savings and investments growing your money. Interest rates also affect how much you earn on your savings and investments. When interest rates are high, banks will usually pay you a higher interest rate on your savings account. That's good news for savers. It means your money can grow faster. Similarly, when interest rates rise, the returns on certain investments like bonds tend to increase as well. Bonds are like loans that you make to a company or government. Of course, when interest rates fall, the opposite happens. You'll earn less interest on your savings and the returns on some investments might decline. Section 6. The big picture, interest rates and the economy. Interest rates are like the heartbeat of the economy, constantly pulsing and influencing various aspects of financial life. They affect everything from how much businesses invest to how much consumers spend, impacting daily decisions and long-term plans. When interest rates are low, it's like a green light for the economy, encouraging growth and expansion. Businesses are more likely to borrow money to expand, which can lead to more jobs and increased economic activity. Consumers are more likely to take out loans for big purchases like houses and cars, fueling further economic growth. But when interest rates are high, it's like a yellow light, signaling caution and restraint. Businesses may pull back on investments, and consumers may think twice about taking on more debt, leading to a slowdown. This can slow down the economy, reducing spending and investment across the board. So interest rates play a crucial role in shaping the overall economic landscape, influencing everything from employment rates to consumer confidence. Understanding how interest rates work can help businesses and consumers make better financial decisions, navigating the complexities of the economy. Ultimately, the ebb and flow of interest rates are a fundamental part of the economic cycle, affecting everyone in different ways. Section 7, Navigating Interest Rates, Tips for Your Wallet. So how can you make smart financial decisions in different interest rate environments? When interest rates are low, it's a good time to consider refinancing your mortgage or any other high-interest debt you may have. You might be able to snag a lower interest rate and save money on your monthly payments. If you're saving for a big goal, like retirement, explore different investment options that might offer higher returns when interest rates are on the rise. And always remember, knowledge is power. By understanding how interest rates work, you can make informed decisions that will benefit your financial well-being.